Today on the podcast, we have Danny Lobina. Danny is the newly appointed SBA director at Sunflower Bank. And Danny recently published an article on LinkedIn that posed the question, how do you know when you can trust your banker? And in this world of fintechs and fast promises and the highly sought after secondary market premiums, it's a valid question. Let's take a listen. Hey, Danny, how you doing?
Doing well. How are you doing, Ray?
I'm doing good, man. Doing good. Where are you based out of? Arizona, is it? Or
I'm actually in Kansas City.
Kansas City?
Big old state of Missouri.
I'm glad you joined because I wanted to talk to you about a couple things. One really caught my attention. You wrote an article on LinkedIn, and I hadn't really seen anyone take that take before, and I want to get into that with you in a minute. On a couple of those things. It was well written. First, like I do with a lot of my guests, if you've seen this, I want to understand your background. And I was looking at your LinkedIn, and this might not seem pertinent to our business in terms of SBA, but I was actually really interested. And you spent 14 years working for Walgreens.
I did, yeah. I spent some time in retail out of college and didn't really know what I wanted to do. I was already working there and, kind of went into the management tract and started opening stores for them. And 15 years later, I realized, that wasn't what I wanted to be doing for my entire career.
I have not seen too many people, to move careers after, essentially you were there for 14 years, I think is what it said, to make that big of a pivot at that stage in life. You just don't see it too often. What really prompted you to do that?
Really just the nature of retail, growth strategies of a company. Sometimes it can affect employees when you grow too fast. You lose sight of what the original mission is. And so people were no longer the focus. The shareholders were the focus. And so, I saw a lot of my colleagues that had been there a very long time start to leave. And, the writing was on the wall that, if I wanted to continue growing as a professional, I needed to find it in another industry.
And so what'd you do?
Yeah, so I went back, got my MBA, and at that point, I didn't really know what I wanted to do, but I knew I could parlay that P&L experience. We were responsible for, 30 to 40 employees. We had HR responsibilities. We had sales responsibilities, managing to about a $5 million P&L each year. So, you had that financial background, that ability to, diagnose a business, find out what's wrong and, work on growth. And so I translated that into my next job, which was with the Small Business Development Centers, an SBA program. And so that was kind of my first foray into SBA, was the Small Business Development Centers, and kind of taking that experience that I had learned in a large retail operation and helping people start and grow small businesses, with that experience.
And then you jumped from there. By the way, you could have gone so many different directions with that. It almost sounds like also, when we finance business acquisitions, you see people with that type of experience where they have relevant P&L management type of experience and they want to go buy their own business. You could have gone a whole bunch of ways with it. But you ended up going to a bank and then actually going to work for the SBA. Is that right?
Yeah, that's right. So, I went into commercial lending. My experience at the SBDC kind of, networked me into the community, and, kind of a natural progression really is taking that financial background and moving it into a financial institution. And the connections I made along the way were attractive to the bank. And so, they brought me on as a commercial lender, and, I had a small focus area of SBA, being in a SBA program, and part of your goals of the SBDC is funding for clients. And, I took a special interest in SBA at that time and learned the programs and decided it was a good tool for especially those early stage businesses. So kind of parlayed that into, I made a lot of good connections that were interesting to the bank, being in a smaller community at the time, really focused on smaller lending opportunities. And so I really liked doing what I was doing, but I ended up at the SBA because, I met my current wife, and had to move across state, and there wasn't an opportunity to move with that bank, but there was an opening at the SBA, and I applied for it and got it.
Wow. So you've been on that side. That's not, there's not a whole lot. There's some, but there's not a whole lot of people that have actually worked for the SBA and then, kind of bouncing back and forth like that. What was that like? Did that experience help you see the program and approach your bank job in a different way?
Absolutely. I mean, a lot of banks, I think, probably take the wrong approach with SBA, and I'm not saying that as a negative. I think every bank has a strategy, and they need to define what that is. When you're working on the other side, let's say for SBDC, helping the entrepreneurs prepare for funding, or you're working directly for the SBA, which is the advocate program for the borrower, it's a little different target than when you're on the bank side and you're saying, okay, well, now I'm taking my depositors' money and putting it at risk in these programs, right? So at the SBDC and the SBA, your job is to promote the programs from really the borrower's perspective, that these are programs available to help fund small businesses. And so the risk appetite is very different when you're working from the entrepreneurial side than it is working from the bank side.
Yeah, well, I think what you're kind of dancing around here is, you talk about the spirit of the SBA program. Okay. This whole program was created to help ensure that small businesses have access to capital. It's a job creation program, and banks and the non-bank lenders have turned this into an industry, a very profitable industry in some cases. So when you say some banks have the wrong approach, is that what you're referencing?
No, I think some banks, I think they dip their toe into the water rather than saying this is a focus that our bank is going to take. So I don't think the banks that have different strategies on full-fledged SBA programs are the problem. I think the problem is the banks that don't take a focused approach. The ones that just say, oh, my commercial lenders are going to do SBA and this and
Gotcha.
this and this and your car loan and your mortgage. I think those are the ones. You have to have specialists. You have to have people that truly understand the program. I mean, the SOP is over 500 pages long, 600 now with the revision. You have to have somebody who truly understands it and can direct those other people. At a minimum, you need at least a few people in the bank that are experts that can help train and support the other lenders on the program.
Well, I agree with that. I mean, you need a specialist with this type of program, 100%. So when you left the SBA, you went to a bank, and this was like 2017, I believe. And what was your role there?
So when I left the SBA, we had some staffing issues at the district office, and we'd really gotten to the point. There was a hiring freeze at the government, and there started out being 6 people specializing in lender relations and 5 people in economic development. And by the time I left, I was the only lender relations specialist, and I also picked up the economic development duties. So
that's classic government.
It was a lot for one person. Yeah, you have about 1,000 lending institutions in an 89 county footprint, and so it was a lot. Your phone is ringing all day long. All the bank visits, all the training for SBA are one person's responsibility, and it can be a bit much. So, and during that, I had met my soon to be new boss through some of the presentations we'd done at some chamber organizations, and I knew that bank was really trying to get a foothold in SBA lending, and it was the perfect opportunity to take the skills I'd learned in all of these other places and focus it into becoming an SBA BDO, and that was very attractive to me. So it was hard to say no to that opportunity. I know leaving a nice, safe government job probably seems crazy to some people, but I was better suited to private sector. I wanted to move at a quicker pace, if that makes sense.
Were you in production, sales management, or both?
So both. Initially, I started off as a BDO, and I was doing just my own production. And then within about a year and a half, realized that I had the skills to, grow and lead an entire team for the footprint of the bank. So, and I took that player coach role initially and, did my own production and managed the team as well. And then finally that transitioned into, the full-fledged sales manager, where I was managing all of the BDOs in all markets and focused strictly on growing sales among the team.
Interesting. So I saw one of the accolades on your LinkedIn was the 2020 top performer an internal award given by the bank. What was that given for?
Production. I ended up as player coach during 2020. I was the number 2 producer in loan volume, number 1 in fee income, number 1 in growth of the portfolio and deposits. So it was really about taking on the management responsibilities while also continuing to perform well as a BDO.
So you come out of the government job and you just start kicking ass, and you're pretty quickly recognized as someone who can lead the team, and then also you're producing and managing the team, extra responsibilities, and almost doing as much as your top guy or gal. What were you doing? Like, what was it about your approach or your daily habits that had put you in that top performer spot?
I had leadership skills in my background. I was a regional manager at the Small Business Development Center. I was a store manager and group leader at Walgreens and those prior responsibilities. So I was very familiar to managing and running a team, but also just, the soft skills that you need in business, which is being able to communicate, being able to, track your progress, and organize your process. So, I manage myself to an Outlook calendar. I always know what I'm doing, what I'm supposed to do, where I'm supposed to go, who I'm supposed to meet with. And then just really good at follow up. Just making sure that I follow up with those leads. And really the biggest key, I believe, was COI development and showing them a different level of expertise than my competitors. And that was going in and doing lunch and learns and presentations and getting in front of, more potential COIs, more potential clients, and presenting on SBA. And I was really good at taking a complicated government lingo program and breaking it down into layman's terms and showing people what the benefit is to them.
Okay, so a few things there. The first one that perked my ears was the calendar stuff. Obviously, if I have a meeting, it's on my calendar, but do you do anything else in terms of like blocking out certain time for certain tasks that only involve yourself? Or are you just talking about setting meetings? You do that.
No, yeah, I block off time. I usually have a day in which I do COI follow up. There's a day in which I, helps team members with one-on-one discussions. There are times that I set aside to review deals. So yeah, I would certainly block off spaces on the calendar and utilize that as specific time where, I wouldn't answer the phone during periods if I was reviewing a deal. I also, took the approach with my COIs, as there is no bank that's going to do every deal. So you have kind of a target approach, you want to hit the ball down the fairway, right? And you don't want to end up in the rough. So, your bank has to clearly define what does that fairway look like. And maybe there's a first, cut of rough that you can play in, but that's not your focus. But you certainly don't want to be hitting the balls out of bounds, right? So if you clearly define what that is, it's a whole lot easier to develop your COIs and, find the targets that fit your bank's culture. And that's what I did, so it's really about managing my own time in a way that allowed me to accomplish all the things I need to accomplish.
Yeah, 100%, because the program is so big, the 7A, you can do so many different things with it. And it's honing in on what you actually are getting done and what you're good at, and being able to communicate that to your COIs is like so key. I know I could do things that I just don't want to do in terms of our credit box. So I go out to market really with a smaller credit box than even what I could technically do, just to focus myself and really ensure that I'm hitting on the green. As I really like that metaphor, but yeah. Sometimes you have a good referral source and you're in the rough and you'll go to bat for them if the deal makes sense. So yeah, I'm really digging that metaphor, man. Thanks. You ultimately left that position a few months ago, really, to come to Sunflower Bank where you're at now. What made you make that move?
I had probably the best mentor you could have at my last bank. He was a wonderful SBA, specialist, product knowledge expert, and just one of the best all-around bankers I've ever known in my life. So it was really about, I had an opportunity to take the knowledge I had learned and run my own division, my own department, right? So that's the only reason I left. I loved what I was doing, but I moved over to, a program that was kind of a fledgling. This bank has had PLP status for exactly 2 years. been doing SBA lending for about 3 years. So they, through their previous processes, had done a wonderful job of growing a program to 100 million without any solid processes or strict business development officers or straight business development officers. They kind of did it through their business banking and commercial groups. And so it needed organization. It needed somebody to come in and say, look, hey, we need to iron out a solidified process. We need to understand what it takes to grow to the 250 million mark. And so I looked at that as another wonderful entrepreneurial opportunity to, take over a program and run with it.
That's a big number you just said, 250 million. Is that over several years?
We hope to try and get close to it. And if my boss is listening, hit it on year one. But yeah, it's certainly going to be a staged approach. We have to lay the foundation first. So, instead of just jamming deals through and expecting success, we have to lay the foundation first. And so there were some operational changes. There's some procedural changes that need to, be implemented. One of those is we're looking to, automate the small loan process. As you know, most of those, smaller SBA loans can be unprofitable to the bank. And so a lot of banks avoid them. So instead of avoiding them, we want to look good in SBA's eyes. They're really drilling down on lowering the average loan volume in SBA because there's the appearance to Congress that banks are just wanting to do the big loans and make money on them. And I'm sure that's true for many banks, but for us, we're a small regional bank, mid-sized to small regional bank. We service 6 states. We have 88 banks and about 50, 60 business bankers in those markets. And so we're looking to serve rural markets as well. How do we effectively do that? And I think automation is a key, having an online application and, some algorithm underwriting, but still a personal touch. So we're looking to review those credit memos ourselves, not have a full automated system. We're not looking to be a fintech. We're looking to be a community relationship bank, but also figure out how to compete in the marketplace and serve a clientele that we know is out there, and do that in the small loan space efficiently, effectively, and profitably.
Technology has to be a part of our industry moving forward, not to replace us, but to help us.
Right. We can use the people in the bank to work on the larger loans while we have assistance through technology on the smaller loans and be able to do both things rather than say, look, our focus is going to be shifted here because of the cost of doing business.
What's your plan to meet that aggressive goal of yours? Hire BDOs?
Yes. So right now I have 2 BDOs on this team, wonderful people. I'm looking forward to get to know them better and, help see if I can increase their skill set, broaden their COI base, and figure out how we bring more business in from that level. But it's really a 3-tiered approach. We've got our business banking group here, we have a commercial group here, and we have our BDO team that we are growing. So it's really a team effort, putting the proper process in place, hiring BDOs that align with our core mission, and working on training and development of the existing business banking and commercial groups. And we have to define a target. If you want to hit the fairway, you have to give a clear target as to what that goal is. What kind of deals fit within that goal and strategy, and then execute on it.
I want to talk about that article. Basically, the point of the article was kind of quality versus quantity or speed or whatever you want to call it, or like how do you know you can trust your banker essentially? So like what inspired you to write that?
Just seeing how some of the competitors in other markets operate. I mean, I would see term sheets come in that we were competing against, and this is not in my core market, these are other markets. I'd see a term sheet come in and it would have eligibility issues straight in the term sheet, and I'm like, they can't do this. They're presenting an offer that they can't follow through on because either you have an inexperienced BDO out there presenting a term sheet without any kind of review from credit, or their bank doesn't understand SBA well enough to understand when they are violating SBA rules, and with PLP lenders, it can be that way. There are banks out there that are ultra aggressive that will throw a term sheet out. Maybe they follow through with it and they close the loan incorrectly, and SBA is none the wiser because they've trusted the bank to understand what the rules are, and they don't understand the rules. So if they don't get that file, if it doesn't pop up in one of the audits, one of the files being audited, or that loan doesn't go bad, it may make it through the entire term of the loan being closed incorrectly.
It's the borrower, because my kind of North Star is always like the business, and it's them rolling the dice, essentially, because even if it's not even ineligible, it's just like, why would they do this? It's like just crazy. And I always look them up because all the data is public in terms of like how many SBA loans and PLPs they've pulled, essentially. There's been times where I said, hey, they've only done one. Like you're at that point, you don't want to go with that bank because you're going to just be their guinea pig here as they try to experiment and figure out SBA. But if they do a lot, and I've seen that too, then it's like, okay, they're gambling or rolling the dice in terms of like, they're saying they can do this. I think it's ineligible. But if they do it and they close it and the borrower gets the money, then it's really just on the lender. The borrower got what they want.
Right. And it kind of circled back to one of the original points was banks that are doing it wrong. And that's what I'm referring to. Not that being a fintech is bad, not that doing secondary market sales is bad. It's the approach of being ultra aggressive and selling and not knowing what you're doing that is the problem. And you see those banks throw out term sheets and that that's not what's best for the client. So I think that's really the key, is being a relationship driven bank rather than a transaction driven bank. My focus and my point in writing the article is we are trying to attract relationships. We are trying to do what's best for our borrower while protecting, the taxpayers who are fronting the money for SBA programs and, the depositors of the bank. So, we are deposit focused. We are treasury focused. We are loan focused, all in the same. So we've got to do what's right for our borrower.
And you do call out the fintechs in there because the fraud of PPP has been rampant, and it's all pointing back to the fintechs. Why do you think that is?
Probably a lot of it is due to the fact that they, before entering PPP, maybe they didn't have an SBA program or a solid SBA program. They didn't know all the government regulations. And that really goes back to, do you have a banker you can trust? Because a lot of the fintechs, do they even have a banker that you're talking to, or do they have a salesperson? I think it's very important that, especially with SBA BDOs, that you don't come across as a salesperson, that you don't act as a salesperson. You're not selling, you're building a relationship, especially with a long-term SBA note. You're trying to do something and help a borrower that a typical banker probably isn't skilled in doing.
It's actually interesting because it's like there's multiple schools of thought in our industry. And one of our last guests was from CIT, and they consider themselves a professional sales organization, and their BDOs were professional salespeople, and they sold, and the flip side of that is the banker. I'm going to be your local banker. I'm going to present you with options. I'm going to give you advice, work closely with you, and be a partner with you. It's interesting. It's just two kind of schools of thought, I guess.
Yeah, and I think there's probably a blend there. It goes back to, the doctor reference of being a specialist. I'm still a banker, but I specialize in this area, right? So I want to be the expert. I want to be the number one cardiologist in SBA. You know what I mean? I don't want to take the approach of, I do SBA. I want to be SBA. I want to be the best. I want everybody in town to ask me their questions, right? I have COIs and other banks that call me with questions. It may be a COI that they know it's not in my fairway, right? It's a deal that they can't send to me, but they're hearing something from another bank, so they'll call me and ask me questions. That's the relationship that I'm talking about. I want to build that deep relationship with a COI and with borrowers. A banker may leave a bank, but that borrower is still with the bank through the term of that SBA note. So I still want that borrower to call me and say, look, you're the one who helped me. It doesn't matter what the flag on the door is. You are the expert I want to talk to.
When you do it right and you sit down and you take your time to lay out options, etc., it takes more time. And I feel like in this day and age, everyone wants everything now. And I've been seeing that more and more. And that's not everyone, but there's definitely a segment of the potential borrowers out there that want it done fast. And that's like always the thing. It's like, and which is weird because everyone used to think this took 6 months, maybe 10 years ago and beyond. And, we would always tell them like, no, we can do this in 60 days. Now it's like, we want it done next week. And I'm like, oh, well, that's not possible. But speed is a go-to-market for the banks. What are your thoughts on, folks, and I'm probably one of them, bragging about, hey, we got this approved in, this amount of days?
I think speed is important. I really do. But I think it's about the process and making sure that you're checking all the boxes you need to check. I want to do exactly what SBA and the bank require, no more, no less. It's not about trying to, speed up the process so fast that you start making mistakes, or that you're putting anyone at risk, especially the borrower. I think what we need to remember is that we work for the borrower. When they come to us and they trust us with handling their transaction, they are my client and they are who I'm trying to satisfy. And whether a bank process is ideal or not really should focus on, is it ideal for the client? It may be a little more burdensome on the bank, but are we doing what's right for the client and making it easier for them? So one of the things we're doing is trying to revise our applications to make sure that there's no redundancies between 1919s and bank information. I don't want a client sitting down and filling it out and going, why'd you ask for my EIN 3 different times?
Right.
I want it to be easy. I want it to be right, but I want it to be efficient as well. It's trying to strike that balance between efficiency and correctness, I believe. And that's what my focus is trying to give a good client experience, and trying to make sure, though, that we check all the boxes that SBA is asking us to check.
I mean, two of the big factors for us in being able to turn around things as quickly as possible are, technology, and the lenders that are embracing technology will definitely drive some efficiencies. And then just staffing, which has been hard this year. Well, it's been hard for, I guess, the last year or so in our industry, because we've seen this huge boom and no one's been training anyone like into the industry the past decade or whatever. So it's like we're just hiring each other's people. So you need to get enough staffing in a place so that, folks aren't just waiting in a line, waiting to get, their deal underwritten and whatnot. So if you do those things, that helps the borrower. You mentioned the, selling of the guarantee. That's become a widely popular model for banks. I mean, you go down the list of the top, 50 SBA lenders, the majority sell the guarantee, all of the loans. And in the article, you mentioned that, their interests might be conflicted. They might be more interested in generating revenue versus what's right for the business, the borrower. What did you mean by that?
Yeah, certainly not in every case, but I have seen banks that get on the secondary sale bandwagon, and it becomes a profit center to them, and they become more interested in increasing profitability every year. And what that does is it tends to, I'm not saying in every case, but it tends to drive the risk profile up, right? Every year, if you're trying to beat the last year, you have to do more and more deals. And depending on, market volatility, current economic situations, I mean, you may start to approve loans you wouldn't have approved last year so that you can continually beat the number from before, right? And so I think the secondary market sales, the way it generates revenue for the bank, instead of being a long-term strategy, it's a short-term strategy for revenue. I think sometimes you have the danger of, increasing that risk profile and doing things you wouldn't have normally done, and taking on borrowers that are more of a risk to the bank, ultimately putting depositors and taxpayers at risk.
I mean, that doesn't hurt the businesses, because that drives actually free market kind of stuff where they're going to get more aggressive on things and borrowers are going to get better deals. I think what it sounds like what you're saying is actually they're doing it to their own detriment, but not really to the
banks,
borrower.
Sometimes the borrower, because if you're doing a deal you shouldn't have done, you're putting the borrower at risk of failing on a loan. So I absolutely think it can be to the borrower's detriment in some cases. If you decide to, SBA asks that we follow prudent lending, right? So if you do a loan that you shouldn't have done because you're more interested in generating that revenue on a secondary market sale, like here's $1 million loan, and I'm thinking, man, I really shouldn't do this deal, but I can generate $100,000 off the sale of this loan. Yeah, I'll go ahead and do it. You just put that borrower at risk. They're putting a personal guarantee on the line. They have the potential of losing a lot in that transaction.
Right. Sometimes when someone comes to you and you don't, you can't do it, you should go a step further and say, and you shouldn't do this. Like you shouldn't, there was people trying to start, restaurants in the middle of the pandemic, well before we knew anything that was going on. And I would be like, why is now the right time to do this? So I get what you're saying then. And, I feel like if you do that and get to that point, those deals go bad, you have risk because the SBA guarantee is only 75%. And so you're going to, you take a couple of those hits, you're blowing up your own shop. So those lenders don't last long, though. There are a couple that are still out there that I'm like, how are they still around doing this?
I've seen a couple of shops where the people just move from shop to shop, and it's almost like you watch it happen, multiple times, and you're like, when is it going to crash and burn?
I think I know who you're talking about, but yeah, thank you for coming on. We won't name names, but thanks. It was a fascinating discussion, and I encourage you to keep writing articles on LinkedIn. I think it's a great way to get in front of COIs and establish yourself as a thought leader in the industry. So thank you, Danny.
Well, I really appreciate it, Ray, and the opportunity to come on here and speak to your audience. It's been a pleasure.
All right, take care. All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of The Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.